So there's those notes that we have in our group. In case you are not in that group, you will give us your number, so that we can be able to incorporate you in the group. Those notes that I've shared there, introduction. Kuna notes nimeandika hapo, nimepost hapo. Hii class tunataka tuirudishe, itakuwaga Thursday from 11. We are shifting it from Friday to Thursday from 11. Ama mnakuwa na class hapo Thursday 11 to 1. Si sawa hivyo? Ama mnataka saa hii Thursday, si ndio? Thursday from 11. Sawa? So tunataka tuangalie, we want to look at how to prepare the final statements, the final accounts. So there's a question there, there's an example I've given here. Okay, there's those notes, they are twice. The one that I've sent currently, you open it. There's a trial balance there on page 24. The question reads, you open everybody. If you don't have, maybe you let me know. Umeiona? It reads that from the following trial balance of G Steel. Can you see it? From the following trial balance of G Steel, draw up the income statement for the year ended that's 30 September 2009 and the balance sheet as at that date. You have been given the trial balance. We had reached where you extract a trial balance, and we said it is from the trial balance that you now prepare your income statement and statement of financial position. So you've been given there the trial balance, and then the last item there, inventory at 30 September 2009 was as follows. So they want you to prepare income statement. So you write the name of the person, G Steel. Income statement for the year ended, for the year ended 30th September 2009, and then you underline. So here you can put, you have two columns here. We have shillings, and here you have shillings. So this is how you prepare. You start by identifying the sales figure from the trial balance. You start by the sales figure. This is the format, although I had given you the format, but if you did not have it, then you can use this question to outline the format and how it is done. So you identify the sales figure. So from the trial balance that we have, I don't know, you've seen it? So the figure for sales is 380,400. Can you see it? 380. So you write there, and then you less returns inwards. Returns inwards. Another name for return inwards is sales returns. Sales. So return inwards in this question is 1540. So you deduct 1540 here. And then you get what we call the net sales. You get the net sales. So when you do this computation, what do you get? When you do that computation, what do you get? Net sales. How much do you get? 17,000. 380,400 minus 378. 378,860. Yeah, so those are the, and then you less cost of sales. You less cost of sales. So you start with the opening inventory or stock. You start with the opening inventory. Another name for inventory is stock. Opening inventory stock. So you check where it is in the trial balance. So inventory at the beginning of 1st October 2008, it was 41,600. So you write here 41,600. And then you add purchases. You identify the figure of purchases from the trial balance. The purchases figure from the trial balance is 188,430. So you add here 188,430. And then you check whether we have carriage inwards. What is carriage inwards? Carriage inward, we said it is a transport cost when you buy goods from the supplier's premises to your place of business. The amount of money that you incur to carry the goods from the supplier's place to your business. So you check whether we have carriage inwards. We have carriage inwards. So you add, that is part of purchases. Add carriage inwards. So the carriage inwards, I can see it is 3,700. So you add 3,700. And then you less returns outwards. So we said return outwards are goods that you're returning back to the supplier. So in this case, it's 34.10. You less 34.10 here. So these two items are part of purchases. These two items are part of. So when you add whatever you had, the opening stock is what you had, plus the purchases, you get goods available for sale here. You get what we call goods available for sale. You get what we call goods available for sale. So any figure in bracket means subtraction or deduction. So what do you get there? $233. Then you less closing inventory. Closing inventory. So how do you get the closing inventory? It is the last item after the trial balance. It is 44,780. So you less here 44,780. So what do you get? 185, 540, 185, 540. So now this is the cost of sales. That is how we compute the cost of sales. Another name for cost of sales is the buying price. These goods that you sold, how much did they cost you to buy them? Then now you get what we call the gross profit here. So the difference between the sales figure and there is the gross profits. So how much do you get? $193,320. 193,320. And then you check whether we have any other income. In some other question, you get that they have other incomes. Or when you talk about other incomes, you're talking about discount received and maybe rent income or any other income. So you check the trial balance whether they have that kind of income. So in this question, there was no any other income. Once you compute your gross profit the way we have done, you list down your expenses here. You less expenses. So you should be in a position to be able to distinguish between expenses, assets, and liabilities. You should be able to know this is an expenditure, this is an asset, this is a liability. So you go to the trial balance. The first item there, we have inventory. That one you've dealt with it. Then we have carriage outwards. Carriage outwards is an expense. Which kind of expenditure is this? This is the amount of money that you use to carry goods to the customer's place. There is a cost that you incur when customers buy items from your place, and then you carry them to wherever they are doing business. That kind of cost is called carriage outwards. So it's an expenditure. So you write here carriage outwards. So the amount of carriage outward is how much? 2,100. So you write here 2,100. Then make sure that your figures are aligned. Then you give sufficient space between your writings and your figures so that the examiner does not need not to struggle to identify your figures. Okay? Don't write another figure here. For example, you write inventory, it is not aligning with purchases. To align means to be the same. Yeah, so arrangement also matters. These things are standardized. So you need to follow a particular format. So we are identifying expenses. Carriage inwards, we have dealt with it. Return inwards, return outward, purchases, sales. And then we have salaries and wages. So write their salaries and wages. The amount is how much? 61 61,400. And then we have warehouse rent. Warehouse rent. 3,700. Then we have insurance. Insurance is 13,56. Then we have motor expenses. Motor expenses. Motor expenses, how much is it? 1910. Then we have office expenses. Office expenses. How much is it? 412. Yes, we have also we have lighting and heating. How much is it? 800. 894. And then we have general expenses. Another name for general expenses is sundry expenses or miscellaneous. Miscellaneous, sundry, and general are the same. Then we have premises. Is it an expenditure? It's an asset, isn't it? Motor vehicle, fixture and fittings, accounts receivable, an asset, isn't it? Accounts payable, a liability. So those are the only expenses. So we add them. Can we add them? It's good to add when you are here in class. It gives you that practice. Sorry? 72? 72,017. And then we deduct from this, we get net profit. Net profit. So we deduct to get the net profit. So what is the net profit? 121,300 and that is our net profit. Then now we come here and prepare, we write here G Steel. G Steel statement of financial position. Financial position as at 30th September 2009. We start here with the non-current assets. Non-current assets. Then here we have shillings. So we identify non-current assets and we record them. We start with the non. Non, another name for non, means fixed. So we start with the most valuable one. We start with the premises. Premises, the value is how much? 92,000. So we write there 92,000. Then we have motor vehicles. Motor vehicles. The value is how much? 13,400. And then we have fixtures and fittings. Fixtures and fittings. So fixtures and fittings, the value is how much? 1,900. Then we write here current assets. We have current assets. Current assets we start with inventory always, closing inventory, not opening, closing inventory. Closing inventory. The figure is 44,780. And then we have accounts receivable. Accounts receivable. How much is it? 42,560. And then we have cash at bank. Cash at bank is how much? And then you get the total assets there. Total assets. Total assets. Tunaelewana? So you'll be meeting this kind of statements now and then. So then here you come and list capital and liabilities. Capital and liabilities. So you start with the capital. How much is it? 688.43. And then you add net profit. $121,303. And then you less drawings. Drawings, how much is it? 22,000. So you need to know why capital is the amount of money that you injected in business at the beginning. So if that business generates profit for you, it increases your capital, isn't it? And the drawings are what you take from the business for your own use. So they reduce the capital. Are you getting? If you take anything, either you can take money from the business for your own use, or you can take goods. If you do that consistently, then it means you are taking your capital. Are you getting? So that is how we do it. You subtract that one like that. Then here, if there is non-current liabilities, you list them. Non-current liabilities. In this question, we don't have. So you can write your current liabilities. You list your current liabilities. Current liabilities, we have accounts payable or trade payables or creditors. So we have accounts payable. So we write here accounts payable. How much is it? 31,600. So anyone who has added these ones? Sorry? Current asset or the entire assets? Or from the top? Sorry, I want you to add everything from the one. How much you get? You're making a statement. Eh? Oh, okay, so people are squeezing their books. You write big things. Don't squeeze. Some people are very much squeezing. You're saving on the books. Eh? 199,746. And this other one? The same. This one. If you from here to here is this. And then from here to here. So this is 199,746. So that is how we make statements. So if you're writing, you can write. So I can give you a few minutes to write. It's good to write. So you can write. To the final statements. So we have these adjustments that you need to know. Number one, we're talking about accruals. Number two, we're talking about prepayments. Number three, we're talking about bad debts. And number 4, we're talking about provision for bad debts. Provision for bad debts. And number 5, we're talking about depreciation. So you need to know how to adjust those 5 adjustments. So we start with the number 1. We start with the number 1 here. We call it accruals. Accruals. Another name for accrual is outstanding. Sometimes we call it due. Outstanding, due. So when it comes to accruals, so when you open that handout, the handout that is written there, adjustments, you have that handout on adjustments. The handout on adjustments there. So there's that handout on adjustments. So you open that handout. When you open it, we have listed there how to treat this and how to adjust these items in the final statements. So we start with the accrued expenses. So the first here is accrued expenses. Accrued expenses. So we have A here, we have accrued expenses. So what is accrued expenses? Accrued expenses. So it's an expense that is payable or due for payment but has not yet been paid during the period. So it's an expense that is due for payment. You write, the notes are there, you just write if you want to write them, isn't it? At home, but you can just follow here. So he's saying accrued expense, this is an expense that is due for payment but has not yet been paid. So it becomes payable. Due for payment means that you already incurred it, you're supposed to pay it, but you've not yet paid. For example, you've got electricity of 5,000 in a given month, but now you're in the second month and you've not cleared this balance. So this one now remains due or it remains accrued. So you've already incurred it, but you've not paid. That is what we call accrued. So it's an expenditure that has not yet been paid, but it's supposed to be paid. So how do you treat it in accounting? You're supposed to charge it in the income statement to add to any amount of that particular expenditure that has been paid. You're supposed to charge it. You're supposed to recognize it in the statement, the income statement, as an expense in that particular period. And then because you have not paid it, you transfer it to the statement of financial position as a liability. So they have given their example. We have an example there. ABC Enterprises incurred at 200,000 for electricity. So the amount incurred amount, Kenya shillings 100,000 for electricity. That is the amount incurred. And then for the year ended, for electricity for the year ended at 1st December 2009, 20 of this amount was not yet paid as at the year end. So the amount that is paid is Kenya shillings 80. Unpaid amount is Kenya shillings 20. So now you're supposed to open the ledger accounts to show, you're supposed to open the ledger accounts to show the treatment. Now you come here and open the electricity account here. So we have electricity account. So you open electricity. So we said when you pay for any expenditure, you credit bank and you debit that particular expenditure. So you can write here bank or cash, whatever. So they will be paid through cash. 100. So the amount that was paid is 80,000. But we know 20,000 is not yet paid, isn't it? So we debit this one. We debit expenditure. We write here accrued electricity. We write here accrued. We write here accrued electricity. Accrued electricity account, 20,000. Then we open another account here. We call it accrued electricity. Accrued electricity account. Then you write here electricity. Electricity 20,000, double entry. So now the total, this now becomes 100,000. So this one you take it to profit and loss account. P&L stands for profit and loss. So you recognize in your profit and loss account 100,000. So that one is done there. And then this one you take balance carried down here. Balance carried down is 20,000. So this one is So this is a current liability. And the total charge in the income statement for that period is 100,000, although it's only 80 that was paid. That portion that was not paid, you recognize it in the income statement, but you still take it to the statement of financial position as a liability, a current liability. So that is how we treat accrued expenses. And then B, we have what we call accrued income. Accrued income. So this is income that relates to the current year, but cash has not yet been received. So the income that relates to the current year, but cash has not yet been received. For example, you have a rental property like this building. So your tenant is still having some balance to clear, although he's supposed to clear. He has already used the premises for a particular months, but has not yet paid. So the amount that is not yet paid is called accrued income. So how do you treat the accrued income? You should recognize it in the income statement as the income for that particular year, and you should take it to the statement of financial position as a current asset. Example is given there. A trader let out their premises for yearly rent of 200,000. So the yearly rent, the total amount that yearly rent, the rent amount is 200,000 in a year. This is the amount that is supposed to be received in a year. So during the year ended at 1st December 2009, the tenant had only paid 150. Amount paid or received amount, it is 150,000. 150,000 in respect for rent. 50,000 was still outstanding. Outstanding amount is 50,000. So now how do you show it? If you open the ledger accounts here, you open the rent income account here. We have rent income account. So when you receive income, we said you debit the cash or the bank. So the total income paid for the year, you debit bank and you credit here. So here you write here bank, 150,000. But we know 50,000 is not yet paid. So we debit this and we credit. So we write here accrued rent income, accrued rent income, 50,000. And then we open here accrued rent income here. Accrued rent income. So we have credited here, we debit here, we said rent income, 50,000. So this one we take it to the balance sheet as an asset, 50,000. And 50,000. And the amount we recognize in the income statement as income from rent is 200,000. So right here, 200,000. And then you write here profit and loss account, 200,000. So that is how we treat accruals. Anything that is not clear. So this one is in line with the accrual concept of accounting, which states income must be recognized in the period earned, irrespective of whether they have been received or not. Expenses must be recognized in the period incurred, whether paid for or not. So that is the accrual concept. Are we together? So now we go to number 2. We call it prepayment. Prepayment. So number 2, we go to prepayment. So prepayment, we have prepaid expenses, prepaid expenses. So what are these expenses? So we go to the sec prepaid. This is prepaid expenses. It is an expense that is not yet payable, but cash has already been paid. So it has not yet been incurred, but you have already paid it in advance. In other words, you paid in advance before you incur that particular expenditure. So how do you treat prepaid expense? Prepaid expense should not be charged in the profit and loss account, but should be carried forward for the next financial period and should be shown in the balance sheet as a current asset. So a prepaid expense should not be charged in the current income statement. And so you should deduct it from the total amount paid. You only retain what relates to that particular period. Any portion that is for the next year, you carry it forward. So you deduct it from the current period amount. And then you take that portion that has been prepaid to the statement of financial position as a current asset. We have been given an example there. ABC Enterprises incurred a total of 100,000 for wages for the year ended at 1st December. So the total amount to be paid was 100,000. So this is the amount that relates to that particular year. That is 2010. The total amount paid for the year was 120. They are only supposed to pay 100,000. This is the only amount that is supposed to, it relates to that year of 2010. But they did not pay 100. They paid 120. So they paid in advance how much? 20. So now you're going to open here wages account. We're going to open wages account. So when you pay an expenditure, we said you credit bank or cash and you debit here. So you're going to write here bank. The total amount that was paid, 120. Of this one, we know 20 is not for the current year. So we write here prepaid wages, 20,000. Then we open prepaid wages account, prepaid wages account. And then we write here wages, 20,000. So profit and loss account, you only recognize 100,000. We deduct. So this will be 120. This is 120. And this one balance carried down, which is 20,000. So this is an asset. Assets always have debit balances. Assets have debit balances. So you're only going to take 100,000 that relates to that particular year. So that is how we treat prepayments. And then numbers, we have prepaid incomes. Prepaid incomes. This is income that is not yet due, but cash has been received for it. Income that is not yet due, but you have received cash. This is where you receive income in advance. So how do you treat it in account? Prepaid income should not be reported in the current financial period. It should not be reported. It should not be recognized in the current financial period because it is not for that period, but should be carried forward and reported in the period it relates. So you should carry it forward and report it to the period that it relates. Prepaid income should be shown in the balance sheet as accrued liability. It is an accrued liability. For example, if you pay school fees in advance for the next period in this school, isn't it? To the school, that is a liability. To the school, that is, in case next semester comes and you say you don't want to proceed, then it means your money should be refunded, isn't it? That is what it means. So to the school, that is a liability, but to you, that is an asset. So now, they have given here an example. A farm received a total rent of 200,000 for the year ended at 1st December 2009. So the amount of rent received was, amount received 200,000 shillings. Amount received 200,000 shillings for the year ended at 1st December 2009. Of this amount, 100,000 related to the year 2010. So 100 prepaid amount is 100,000, meaning in that year, the only amount that should be charged as rent is 100. So now, required, show the ledger accounts to record the above. So we're going to open there the rent income. So we're going to write here rent income. So when you receive rent income, you debit bank and you credit this one. So you write here bank, 200,000, the total 200,000. But we know 100 is not for the current period. So you write here prepaid rent income, prepaid rent income, 100,000. Then here we write prepaid rent income. So here we have credited, here we have debited, here we credit. We say here rent income, which is 100,000. So the one that you recognize is the profit and loss. Profit and loss is 100,000 only. This one balance carried down. This is a liability. Liabilities have credit balances. Remember what we said when you're balancing off the account. If this side is the greater side, then that is a credit balance. So that is how we treat prepayments. And we are done now with that one. We go to the bad dates. We go to the bad dates. So we have bad dates. So bad dates, what are bad dates? And how do they come? So bad dates, what we have written there, it refers to account receivable that has been specifically identified as uncollectible, and therefore it is written off. A bad debt occurs when you sell on credit, and then you are sure of that one of your debtor will not pay. For example, you sell to someone and that person dies, isn't it? It is automatically will not recover that amount, isn't it? Now, to whom are you going to recover from? And the person you sold to is dead, isn't it? So that one, it means you will not recover that amount. So you need to write it off in the account. So you debit bad debts as an expense and you credit debtors. You credit debtors. For example, debtors are credit customers. Debtors are credit customers. You have sold on credit to a total of 200,000. So balance go down. The amount you anticipate to receive from your debtors is 200,000. But you discover that one debtor will not pay. Either maybe is bankrupt or is no longer in existence. So now holding maybe 20,000. So to write it off means you credit debtor. So you write here bad dates. You write here bad dates. 20,000. You eliminate this one that you're not going to receive. This one you are sure, 100% sure you're not going to get. So there's no need to retain it in your books. And then you open another account called bad debts here. You open another account called bad debts, and then you write here debtors. So this is 20,000. So now here you remain with those ones that are going to pay. Balance carried down, which is 108. And this one, you take it to the profit and loss account as an expense. If you sell on credit and the customer is not going to pay, that amount that is not going to be paid is called bad debts, and this becomes an expense. So that is how we treat bad debts. We eliminate it from the debtors and we create another account called bad debts. So bad debt is an expenditure. So that is bad debts. So we are through here with bad debts. We go to provision for bad debts. We go to provision for bad debts. Provision for bad debts. We go to provision for bad debts, or provision for bad debts or allowance for doubtful debts. Provision for bad debts, stroke allowance for doubtful debts. Are we together? A provision is an amount that is set aside. It is just an amount that is taken from profit. You set it aside to cater for any eventuality, mostly a likelihood expense. So you don't overestimate your profit. For example, a good example, in a given year, in a given period, you've generated a profit of maybe 500,000. This is the total profit you generated. And then that particular year also, you have debtors you've sold on credit to a tune of maybe 100,000. So these are the debtors, those people who are supposed to pay you. But now you know very well, out of the total debtors, at a particular percentage you don't pay, maybe 10%, isn't it? 10% of my debtors usually don't comply, don't honor the obligation. So 10,000, 100,000, it will be 10. Now, instead of reporting a profit of 500,000, and you know there's likelihood of losing 10, isn't it? So you say, I'm going to stand in for this one. So instead of reporting a huge profit that it might not be there, I'm going to deduct how much? I'm going to pay for those ones that are likely to not to pay, isn't it? It is not good to paint a rosy picture which is not there, isn't it? So you're painting 500,000, but in reality, there's a likelihood of losing how much? 10,000, isn't it? So that is what is called provision. It's called provision for bad debts. So it is amount that is taken from profit to stand in for those debtors that are likely not to pay. it is now born out of the experience you have been in business. When you're in business for a while, you're able to estimate things. You're able to know, this one is not going to be, this is not, this amount, this percentage will not be paid. So that is a provision. So now what I've written is an amount that is put aside from the profit in order to meet a probable or a likelihood expense or a reduction in the asset value. Provision for doubtful debts, it is estimated amount of bad debts that will arise from accounts receivable that has already been issued but not yet collected. So how do you treat now? How do you account for this? So these two things are different. Remember, this one is already confirmed to not be paid. And this is just a provision, isn't it? I can estimate that you will not pay, but eventually you pay, isn't it? I can say, this one will not pay, but you pay, you pay. So this is just an estimate to reduce. This is in line with the prudence concept. You remember the prudence concept? You remember the prudence concept? Anyone who remembers? So you start reading, isn't it? So now how do you account for provision? Entries made in the provision. If it is the first time of trading, that is the first year you are creating that provision. So you debit profit and loss account, debit profit and loss account, and credit provision for bad and doubtful debts. So that is the first year of creation, or the first year of creating this, first year of creation. In subsequent years, in subsequent periods, this amount can either be increased or reduced depending on the analysis. For example, if you provided maybe 10,000 in 1 year, and then you discover that most of the debtors are complying, isn't it? They are honoring their debts. So there's no need to put that amount in that account. You take it back to the business to circulate to bring in more money. If you discover that the debtors have been defaulting more than the estimates, then it means you have to increase that amount. So in subsequent year, if an increase, you debit profit and loss account and you credit provision for bad debts. Provision for bad debts. So this one with the increase, If a decrease, you debit provision for bad debts, and you credit profit and loss account with the degrees. So that is how we treat it. Now let me demonstrate. Let me demonstrate an example. So for example, you have year 2010. We have year 20. This is the first time you decide to create that account, provision for doubtful debts. And then the amount that you're putting aside in that year, it is maybe 10,000. So the amount that you want to set aside for provision for bad debt is 10,000. So we are saying you'll open an account called provision for doubtful debts. So it is the first year, so you write here profit and loss account. Of course, this amount, you're going to take it from the profit. So this one will be an expense. So you debit profit and loss account. And then you balance carry down here would be 10,000. That is 10,000. That is in year 2010. Come year 2011, and then you assess, this amount is just there. It's not that it's gone anywhere. And then you find out that debtors defaulted more than you anticipated. So there's need to increase this amount by maybe 5,000 to make it 15. So already you have this 10,000. So what you do, you just open here, you write here provision for bad debts. So you say here, balance brought down. Balance brought down is already you still have 10,000 in that account. So you want to make it 15. So the amount that you're going to get from the profit and loss in that particular year, 2011, profit and loss account, it will be only 5,000. So the balance carried down here, now you have 15,000. You have 15,000. Tumelewana. But supposing you realize that more debtors, most of them complied, there's no need to have this money. At least you need to reduce 5,000 and half of it to bring back to business to circulate so that it can create more money for you. What you do is this, you open provision for bad debts here, provision for bad debts. So balance brought down, it was 10,000, but there's no need to hold 10,000 in this account. So what you do, you write here, you say here profit and loss account. You want to only retain 5,000. You want to take back 5,000 into business. So the balance carried down here will be 5,000. So that is how we treat provision for bad debts. A good example is when you have kids at home, small kids, you know them. So their immune system is very weak. They get sick every now and then, isn't it? So you say, let me put 10,000 aside to cater for their medication so that when they fall sick, you are not stranded. At least you have something to stand on, and you take care of them in terms of medication. So here, months after months, they are not falling sick. They are still strong. You don't get any negative reports as they are sick. So there's no need to hold this amount, isn't it? You use it somewhere else. If you're a business person, it assists you. But now if they fall sick and they consume the entire 10,000 in any given month, then you see this amount is not sufficient. You increase it, isn't it? So increase it from 10,000 maybe to 50 or 20. So that is what it means by provision. But remember, there's nowhere that this amount is going. It's just a provision. So that is how we treat provision for bad debts. Now we go to the depreciation. Go down there, depreciation. Go down there, depreciation. So depreciation, it is a loss of value of non-current assets throughout its period of use by the farm. So when you buy an asset, this asset will not be with it forever. It loses value with the time. So you need to recognize that one, and then you deduct it from your income, so that that amount that you're getting from your income will assist you to replace that asset. Are we together? If you buy a car, it doesn't mean that whoever you're buying that car from will tell you that this car has a useful life of these years. It will tell you that this car can last for 10 years if you use it well, or it can last for this number of years, isn't it? Even human beings, we have our lifespan, isn't it? You are not a human being. You'll never remain youth forever. They will come, you will depreciate, and you lose value completely, and you die, isn't it? That is reality. The same to asset. This, you will not stay with this computer here in this school forever. A time will come, this computer will not work. So that is loss of value of non-current asset is called depreciation. And then we need to account for it. We need to account for it. So what is it that causes depreciation? What is it that causes depreciation? Number one, physical factors such as wear and tear. So when you use something for oftenly, it wears out. The more you use something now and then, it wears out and becomes not effective. And then rot, decay, and rust. Some people do not know how to take care of the items, so they end up decaying. And then another reason why there is loss of the depreciation is what we call economic factors, such as inadequacy. So that item becomes inadequate. For example, if you start an organization, while it's still young, maybe you might need a car just to carry the staff around, because maybe the staff might be 2 or 3 persons. But when the organization grows, then the car becomes inadequate. You need maybe a bus, isn't it? So you no longer use that car for transportation. So it becomes inadequate, it depreciates. So it doesn't serve the purpose. Another reason for depreciation is what we call obsolescence. That is obsolescence. Obsolescence means Although it's not depreciated, but it's outdated. People no longer using it. Like, for example, typewriters. If you have a typewriter, it was replaced by computers. So you can have a good typewriter, but you not use it. So it's outdated. And then depletion due to extraction. When you extract something, a mineral is an asset. So when you extract it over time, it gets depleted, exhausted. And then we have time factors. Some assets have a legal fixed time. There's some asset you can only use it for a fixed time. So when that time expires, it is no longer in your hands. Now, this depreciation, now we are saying it's an expense. So how do you determine it? How do you determine depreciation? So we have methods of calculating depreciation. So we have more than one method, but the most common one, there are only two. So the first one is what we call straight line method. Straight line. Straight line method. Straight line method. How do we determine depreciation? We have what we call the straight line method. So these methods assist us to estimate the value of depreciation that should be charged in the income statement as an expense. So this method ensures a uniform amount of depreciation charged in profit and loss account for a particular asset. So this one, we determine a particular amount which we charge it in every year in the income statement in the lifespan of the asset. So equal amount is charged in the income statement as depreciation for the lifespan of that asset. If you buy an asset that is valued at 10,000, then you can stay with that asset for 5 years. So it means every year to be losing 1,000. So you're going to charge depreciation 1,000 every year. Every year. So this is how it is calculated. So it is cost minus residual value. Residual value is the scrap value, the value at which you can be able to sell it when it is old, over estimated useful life. Estimated useful life. Every asset has its estimated useful life, or it is the rate times cost of the asset. Example have been given there. So this is how we determine depreciation using the straight line method. Example, a farm buys a machine for 100,000. A farm buys a machine for 100,000. A farm buys a machine for 100,000. So the cost of the machine is 100,000. That is the cost. It expects to use it in the farm for 8 years. So life, it will be used for 8 years. The machine will be sold for 200,000. Under straight line method, depreciation will be determined as, so you take the 100,000 minus 200,000 over 8. So you get 10,000. You get 10,000. So you're going to be charging 10,000 in your accounts every year as depreciation for 8 years. Uniform amount. Uniform amount. That is what we call the straight line method. Number 2 method is called reducing balance method. Reducing. In this one, maybe they can estimate the rate, sometimes straight line, maybe they can tell you 10%. If they tell you the rate, you just take 10% times the cost, maybe 100,000, which is going to be 10,000. So every year is going to be 10,000, 10,000. So now number 2 method of calculating for depreciation is called reducing balance method. Reducing balance method. So here the firms determines a fixed percentage rate that is applied on the cost of the asset during the first period. So there's a fixed percentage rate that is applied in the first period. The same rate is applied in the subsequent financial period, but the rate is applied on the reduced value of the asset. So the first year, you determine a particular percentage that you apply in the first year. The same rate is applied in the subsequent years, but on the reduced value. Reduced value means the cost minus accumulated depreciation. For example is given there. A firm buys a machine for 100,000 and provide depreciation of machine at 20% per annum, reducing balance method. The depreciation charged to profit and loss will be as follows for the next 3 years. So the first year, we have year one. Year one. So the cost, year one, it will be 20%. 20% times 100,000. This is the first year. This is the cost of the machine. This is the rate that is determined. So the rate is determined by the management. So this one will be, the first year, the depreciation will be 20,000. That is the first year. 20. And then the second year, year two. Year two, it's going to be 20%. And then you take 100,000 minus 20,000 for year one. Here you get 16,000. Year three is going to be 20%, and then you take 100,000 minus now the 2, which is 20 minus 16. You can add them. The 2, when you add them, is called accumulated depreciation. So you get 12,800. If there is year 4, you're going to add this plus this plus this. You deduct from the original, and then you apply 20%. So that is how we determine depreciation. Any questions so far? Anything that is not clear? So these are the things that will be tested. The adjustments. This one will be tested. Now, after you've determined depreciation value, so how do you account for it? How do you treat it in the accounts? Remember we said depreciation is the loss of value of non-current assets. So we need to recognize it, isn't it? We need to say we are losing our assets, and this is the amount of money that we should debit our profits to take care of the loss. So accounting treatment on depreciation. When non-current assets are depreciated, you debit profit and loss account and you credit provision for depreciation account. So when you depreciate non-current assets, when non-current assets are depreciated, you debit profit and loss account and you credit provision for depreciation. So in other words, you treat this as an expense. Anything, if you hear debit profit and loss account, it means treating that particular item as an expense. So now, depreciation also accompanies what we call the asset account. So now you also need to know how accounting treatment for assets. When you buy assets, how do you treat them? So accounting treatment for assets account. So we have accounting treatment for assets. When you buy asset, because depreciation is related to asset, so you also need to know how to account for assets. So when you acquire assets, on acquisition of assets, when you buy an asset, you debit asset account. Asset can be motor vehicle, it can be furniture, it can be machine, it can be computer. And then you credit bank / creditor if you bought it on credit. 2, when you dispose of the asset, on disposal of the asset, when you sell it off, you debit disposal account, asset disposal account, and you credit asset account. Here you credit with the original value, with the original amount, not original amount. So when you sell an asset, you don't credit it with the amount of money you're receiving for the sale. You just use the original amount. This is how you treat. And then accounting treatment for disposal of assets. We have accounting treatment for disposal of asset, accounting treatment on disposal of assets. When you dispose of the assets, number one, you debit disposal, debit on disposal account. One, when an asset is disposed of, when an asset is disposed of. When you dispose of an asset, you sell it. That is, when you dispose an asset, you debit disposal account, you debit disposal account, and you credit asset. You eliminate it from your books. Number two, with the total depreciation provided to the date of asset disposal. So this asset that you are disposing of, when you're disposing of, it means you have been with it for a while, isn't it? Maybe you've stayed with it for 1 year, 2 years, or whatever. For this period you have been with that asset, you have been charging it depreciation, isn't it? So now with the total depreciation charge on the asset, with the total depreciation charge, with the total depreciation charge on the asset disposed, you debit provision for depreciation account, provision for depreciation account, and you credit disposal account. That is number two. And number three, with the proceeds on disposal, the amount of money you receive for disposal, with proceeds on disposal, with the proceed on disposal, you debit bank and you credit disposal account. With the balance in this disposal account, with the balance in the disposal account, one, if profit, debit disposal account and credit profit and loss account. Two, if loss, debit profit and loss account and credit provision for dip. This one is very important, not only in this particular, it affects so many other accounts going forward. It affects cash flow. You need to know this knowledge. For you to be able to handle questions on cash flows, this one is very necessary. Disposal of asset, accounting for treatment for asset. So this information that you've seen us displaying here, it will be very helpful when you are doing cash flow statement. So you need to know it. You need to master it. The mastery procedure is the same. When you're meeting information for the first time, if you want to be a good person in terms of reading, reading is very good. But the secret is you don't read it once. You read it oftenly. Something is read oftenly for it to stick. If you read it once, it will not be part of you. Expose yourself to that information again and again, then it will be part of you. So you need to create time to do that. If you read a book once, you'll not absorb much. Read it twice. If you read it third, you can even tell the story of that book. Ukisoma story moja ya mtu, sindio? Ukisoma story tu kitabu fulani umesoma. Hiyo siku umesoma huwezi piga story ya hiyo kitabu. Lakini na ukisoma mara ya pili, mara ya tatu, unaweza iongelea. Because sasa umeijua, sindio? That is how it happens. So now I've given there an example to demonstrate what you have been, these accounts. Are you ready, or we stop at that point? We stop. So we proceed on Thursday. So we proceed on Monday. So we do depreciation and then we do a question that combines everything, isn't it? Okay, sawa. So I have given you the notes, at least you go through them. Eh? In case you have an issue later on, you're always free to ask. Sawa sawa. So that is the end of our class today.